Sunday night. Most people who join already know what this is, so I'll just be doing a quick recap. So if you guys don't know, there's a 2022 mentorship on YouTube if you want to watch it. Again, there's the other guy in here who just doing class probably was telling you whole different strategy, and I don't want to move your mind away from whatever he was telling you. But I mean, ICT is literally how the market moves, so I would definitely suggest learning it because you don't really use any indicators or anything because it's literally how the market moves. But there's a mentorship on YouTube. It's called ICT 2022 mentorship. There's 40 episodes in it, but I definitely recommend watching that. But again, I don't want to steer you away from a strategy if you're already profitable. And when I first started trading, I tried so many different things. I tried EMAs, I tried supply demand, I tried so many different things. And I finally found ICT, which works best for me because that's literally why the market moves and I just understand it so well. So I'm just going to do a quick recap. So basically there's something called the fair value gap, and what that is it's just, see there's a candle, okay, and I'm just going to quickly draw this out. Let me think in this real quick. Actually, I'll just draw with a brush real quick. So you have a candle, and then you have another candle like this, let's say. And watch where I draw the wicks, because where I draw the wicks is very important for this. Okay, so wick here, and then let's say you have another candle down here. So in ICT, what I mean by where it tells you the market moves is you kind of learn where liquidity is and where the market wants to go. And when you're using ICT, you're going to use two things as an entry. A fair value gap, which is one, which is what I'm showing you right now. So what a fair value gap is see how this wick doesn't match up with this wick, see how it doesn't overlap. So the low of this candle does not overlap with the high of this candle. So it creates this kind of gap in here, okay? And you can see that there's probably a lot of unfilled buy orders in here and sell orders. So when you learn supply and demand, which I know Royal Market Burglar does, like supply and demand is, if Royal Market Burglar was drawing a supply zone, he would draw it from this candle. Why? Because it's a green candle before a down move, okay? So this would be like a semi-supply zone, okay? And in ICT terms, this is actually an order block, okay? And this is your other entry, so it's this green candle for the down move. But the main thing that I usually enter off of is these fair value gaps. So it's kind of when you get this wick and this wick, they don't overlap. So let me just show you a few examples on the chart of this. So if we look right here, this is a fair value gap. Why? Because this wick does not overlap this wick. But if we look closely, you can see this wick right here overlaps this wick. See? So there's no fair value gap here. There's only one right here. And why does this work? Well, when you create a fair value gap, algos which are 99% of the market want to trade back up into this and rebalance price and fill these leftover sell orders. And sometimes these institutions manually selling, but a lot of times it's going to be just algos that cause a sell-off. And then why does price want to go back up here is because algos want to get the price back up here, refill their sell orders, and then go down again. And this is, ICT is kind of like a smart money concept thing. There's like other smart money concepts, but ICT says he doesn't really like them because they're not really how the market moves. What he teaches is more correct in my opinion. So this is a fair value gap. And how do you use these as entries? Well, when we get into the fair value gap, you slap puts, or you slap, if you're trading futures, you short. And I'm sure you guys have been taught wait for confirmation, but this is not a wait for confirmation strategy, okay? This strategy works so well that you do not need to wait for confirmation. You're supposed to slap right here, and they teach that because why would you want to wait for confirmation if it skews your risk reward? Sorry about that. And I will say risk reward and is more important than any strategy. No matter if you use moving averages, whatever, like risk reward is like could be a whole class alone. And I'm sure some of you guys have seen the chart. It's like if you're down, or if your win rate's 50%, you need to have at least a 1 or 2 to 1 risk RR. If your win rate is 33%, if your win rate's 33%, you have to have a 2 to 1 RR or more. If your win rate is 50%, you have to have a 1 to 1 RR to be profitable or to be a break even. So like I'm sure you guys know what chart I'm talking about, and I think that's more important But I think ICT is definitely helps you with that. So like, let's say we wanted to short in here. Your risk reward would be, your entry would be, let's say the beginning of the fair value gap. Stop loss is always over the swing high, and I can't stress you enough. I used to struggle with stop losses so much, and since learning ICT, like I know where to play stop losses now. So for you guys who get stopped out and you're like, oh, you get stopped out, and then the price totally reverses and goes your favor after you get stopped out. That's what the market makers do to us retail traders. They stop you out on price reverses. With ICT, we are the ones who buy people when we buy puts when viewers buy calls. Okay, so like we fade a lot of people, and this is kind of a strategy that hasn't come out until recently because I'm sure many people have kept it hidden, but it's kind of a really good concept to understand. So basically what that means is, like, let's say you see a break right here, okay, and you see we're almost a high day. If someone sees a break of this swing high, they're gonna be like, oh, I'm gonna get in calls. There's a break of this swing high, we're probably gonna go hit high day and go more. But no, your liquidity, okay, this is where people stop out and then price reverses. So this is where breakout traders get wrecked, and this is also where short traders get wrecked, because people who short here, the stop loss is above the swing high, they get stopped and then price reverses. So this is how the market moves. Algorithms always want to hunt stop losses, and this is kind of another thing, a main thing in ICT that is important to know. And so yeah, so like let's say right here, a good risk reward I would say is probably 2 to 1. 1 to 1 is fine, but you really have to have like a 60-70% win rate. 2 to 1, you have to have at least a 33% win rate to be profitable. So if you really think about that, if you have a 2 to 1 risk reward, what are the chances you're going to lose 66% of your plays, which is the majority of your plays? If you have a good strategy, that's not likely. So I think 2 to 1 is just really good because you have to have at least a 33% win strategy or win rate. So again, I think that's important. So this is a fair value gap. If we did get up to this fair value gap this morning, I did alert this in my Discord channel, and we never actually got up here. So that was unfortunate. And I don't know if you guys can see my channel. I know some of you guys probably can't, but I'll show you what I kind of showed this morning. So if you look at this, I said I am bearish. So this was at 9:30 a.m. before market open, okay? I said I am bearish because we haven't hit sell side from Friday's dump. If we break over this high, I'll turn bullish. Watching for short setups at the moment. So here's when I said I was bearish, okay? This was at 9:30 a.m. and you can see that I thought price was going to go down here because this is where sell side liquidity is. And the market hunts liquidity, so it hunts stop losses. So knowing this, I knew there was a lot of stop losses down here on this line, and I'll kind of bold it up. And I drew it from 3988 to 3912, so I'll kind of draw the box that I drew this morning. Let me just redraw this. So this is kind of what I drew this morning. It would be invalidated if we broke this, which I didn't think we were anyways. And then I drew this at 3988. So right here, and I thought we'd hit down here. So this is not like a play you would take, okay? So I drew it like right here. This is not really a play you would take. This just gives you kind of a bias. Why would I take this? Well, it's a 1.27 risk reward. And the entry was already over here, okay? So for anyone who knows ICT, here's the entry. And what is this? This is a fair value gap, as I just taught you guys. So see how this wick does not overlap this wick? You can see that as soon as we get to that fair value gap, boom, huge rejection. So here's your entry, and I already saw we got into the entry before market open. So that's why I kind of said I was looking for re-entries for short setups. But you can clearly see I thought we were going to go down here, and it would be invalidated above this swing high. And what happens? Boom. This is not hindsight. I posted this at 9:30 a.m. before market open. I did not edit it. You can see it's not edited. And I do this a lot. So, I mean, some people will be like, oh, it's hindsight. It's not. This strategy is legit. It's how the market moves. I really can't trust it enough. Where do we reject right here? Boom. Fair value gap. Right here. See this? So you can see right here. fair value gap rejection 3910, and I alerted this too. So so look right here. This is from Friday. Where is it? I said, trying a short here, stop as if we hold over the 0.705. And that's another ICT concept, the 0.705 fib. It's the kind of a secret fib that not a lot of people know about. But you can see I said I'm going to short this fair value gap. See how there's wick, they don't overlap. And this is on the 15-minute chart, but this is in the 5-minute, so it's a little more precise. But if you look at the 15-minute, you can see it's still this fair value gap right here. And I said I was going to short it. And obviously you can see I top ticked it as soon as you hit the zone. Boom, huge rejection. Again, this is not hindsight. I literally alerted this in real time before it even got up there. You can see this. And you can see I actually got a very, very quick 10 points. As soon as we hit it, we wick down. That's just an algo wick. I see a lot. And then we got a higher entry. And you can see that this is the stop. This was my take profit. And because of the way the market moves, and because of the way the ICT teaches how the market moves, I was expecting price to go here, okay? And in this situation, if we go to the 5-minute, I'll kind of narrow down the fair value gap a little bit. And it is good when they do match in multiple time frames. Like, as you can see, this 5-minute match up with the 15-minute, which is better. But you can see, look, there's a fair value gap right here, too. This is a bullish fair value gap. So how did I draw this? Well, I drew it from this wick to this wick because they don't overlap. And you can see we get this big candle. And you can see, as soon as you wick into this fair value gap, boom, bounce to this, and then rejection. Why don't we bounce off this again? Well, now that we hit this 0.705 fib, which is the optimal trade entry, you can see that price wants to go hunt down here. Why? Because it knows their stop loss is down here. The trend is down. Why is the trend down? Well, we broke this. We have a market structure shift down here. So if you guys don't know market structure shift or market structure, that's very important to learn. But I'm sure that's one of the first things you guys learned. Knowing market structure is very, very important because it'll tell you when we're in an uptrend. It tells you when we're in a downtrend. It tells you when to break a trend. When we break a trend, that's when you look for a fair value gap retracement. Sometimes you break trends and there's no fair value gap. Well, then you wouldn't enter, okay? Simple as that. And some people who use fibs are like, well, why doesn't this fib work after this trend break? Well, there's probably no fair value gap because there's not a ton of sell orders waiting up there. And I hate to say it, but that's true. And I will say fibs are the second best thing I think in this market. I know some very, very good fib traders who a lot of their entries match up with mine. And I do a completely whole different strategy. And fibs, why are fibs so good? Well, fibs also kind of go along with the algos, which run this market, okay? So fibs are very important to algos. So I know a few very, very good fib traders also. Let's say you don't like ICT, well, you could use fibs, which are much more complicated than this. And it's not just fibs, it's also harmonics and kind of more basic fib, more advanced fibs than just the 0.618 and the 0.382. I'm sure that's what everyone knows, but there's a lot more advanced stuff than that. But you can see we reject this fair value gap. You would not take this fair value gap twice. I never take any fair value gaps twice. So let's say we got up to the zone again. You don't just take it twice. In this example, we don't. So in this example, you can see that we kind of wick down into it right away. And we bounce off the start of it, and then we do bounce off it twice, but we kind of bounce off the lower one. But again, you're not supposed to take fair value gaps twice. But you can see how much this is respected. Like even right here, this is a fair value gap. We have a reaction off this. Like right here, boom, we bounce off this fair value gap, hit this high right here. This is where dumb money longs because they're like, oh, breaking the swing high, I'm gonna go long, and then boom, total rejection. But really, they were my liquidity because this is when I'm looking for shorts after we hit liquidity, okay? And I knew we were in this fair value gap right here, so over this I looked short. So that's a really good example. Another example is like right here. I'm sure some of you guys wondered, why do we have a random bounce today? and then we went down again. Well, it was a fair value gap. So on the 5-minute, we had this fair value gap scenario here. We dumped off open, boom, just we got this random bounce. Everyone was like, oh, I'm turning bullish. No, price wants to go down here. I knew that, so I was not turning bullish. Price, the algorithm that runs this market, it wants it down here. So that's just something you kind of get with screen time and learning ICT. Again, if you really want to learn this, I really recommend learning from the source. But yeah, so you can see what happened in this. Obviously, we ended up hitting this. It was like a 35-point trade. If you really trust your strategy, you really got to wait till the low. But it's fine if you sell a few points before. Like, if you miss out on 2-3 points, it doesn't really matter. But I've seen times where we're so close to hitting the low, then we just bounce randomly, and we go up 10 points, and then we reject, then we hit the low. And some people can't handle that, which I know I can't handle that, because I'm like, oh, I just missed out on 10 points. So why did I not sell 2 points from this low? Okay, it's fine if you do that. Just make sure you're selling at a time where your risk to reward is at least 2R. So you want to sell at least 2R. But again, that you don't have to do that. Many people have different risk to reward strategies. It doesn't really matter. But it's important to have a good risk to reward strategy. But yeah. So I'm sure some of you guys are wondering, well, there's a fair value gap here, and there's a fair value gap here. So which one do you use? You can see that. Let me just move this over real quick. You can kind of see that we rejected this fair value gap, and ideally you don't want a candle close above the fair value gap, although sometimes you get it and we still reject, because if you are taking a fair value gap, your stop loss is always above the swing high. So if you're taking right here, this might be too big of a stop for you. So some people kind of tighten it, which I've tightened it before, hits my stop loss and reverses, and I'm not even mad because the true stop loss should be the swing high. But that's, maybe you want to wait for the last possible fair value gap, where if you took this, the stop loss would be here, versus if you took this, the stop loss would be here. So obviously this is going to be better risk reward than taking this. But that also sacrifices, you might not get this entry sometimes, okay? So we reject this one, and if I draw this, look what happens. This was the 0.705. Right here, we almost top ticked the 0.705, and then we go over a little bit, and then we ended up rejecting this fair value gap. But you can see you still would have got a nice move off this one. Let's say you entered here, you would have had what, a 5-point drawdown, and then you would have had 20-point trade, and that's at 4R, which is pretty good. So fair value gaps are the main thing you kind of want to be looking for in this. If you guys want practice, definitely go look for these in your chart and see how they react. I will say one thing: you want fair. So if you draw a fib, you'll notice I have the 0.5, okay? And above the 0.5 is something called premium. So the algorithm see this as premium. So think if you're going to store, okay, and a price is not on sale. Well, price is at the premium price. It's at the normal price. Who would want to buy it? Everyone would want to sell it, okay? So premium is above the 0.5. That's when you short. And then discount is below the 0.5. So when you go to the store, you look for things on discount. And let me just kind of take this 0.75 up, 0.705 so I don't confuse this. So when you go to the store, you want to buy things in discount. So under the 0.05. And you do not want to buy things over the 0.5. So you want to short it. So using the same concept, when you're looking for a fair value gap, you want to short it in premium and buy it in discount, okay? So if your bias is short and you see we have a market structure tip down, you see we have a fair value gap, well, you want to make sure that you're not shorting below the 0.5 fib, okay? Or the 0.5, it's not really fib, it's just it's like an equilibrium, as ICT calls it. You want to make sure you're shorting above the 0.5, okay? So in this situation, we get to the 0.5, you short it, boom, as soon as we hit discount, you can see algorithms chipping in, buying again, because we're in this fair value gap. And this might be a little complicated, but I'm going to draw another fib right here to right here, this high. And you can see this fair value gap is in a discount, so that's when you want to buy. And you can see we clearly bounce out of this fair value gap. We go back to premium on this giant high, or the higher time frame. We get into premium. We get to the 0.705 in this fair value gap, and then boom, what happens? You short again, okay? And you can see because the bias is bearish, price wants to go all the way down here, so that's really important to take into account. So drawing the 0.5 is coming clutch a lot. It saves me from really bad entries sometimes. Like right here, FOMC, you can see that if you draw this to this, price was above 0.5. Oh, where did we reject for FOMC? Well, we rejected this for value gap. Some people are like, well, why do we reject there the day of FOMC? Well, it was a fair value gap. And you can see it's on the 15-minute too. And this is big, so you can see like part of this fair value gap is also in, if you look closely, this part of this fair value gap, it's in discount, but you want to short this part. You short somewhere up here. And to be safe, I recommend waiting. Like sometimes you just wick above the 0.75, sometimes you just go to the 0.75. Okay, and you can kind of see in this situation right here, we wick a little over the 0.75. This is when you would enter, and then reach your target sell side, which is low right here. So you can see how that works. This is a perfect example. A lot of people are like, well, don't play FOMC, it's gambling. Well, this was just a textbook entry. And I know a lot of people who played it. I scalped it. And what happens again? Well, we know that the target's here. And what if you miss your entry up here? Well, you get another entry. You get a market structure shift here. So here's a break of structure. Why is this break of structure? Well, look, we get a higher low, higher low, higher low. Boom, energetic displacement. Keyword, it's energetic. It goes under the swing low with a fair value gap. We form the fair value gap. And then boom, what happens? We reject this fair value gap and then back down again. So another textbook example. And was this in premium? Yes, it was. So if we draw the fib from this high to this low, it was right above the 0.75. I'm guessing around the 0.62. And you can kind of see how this works. So we go on this fair value gap, reject it, and then boom, here's your target. This is your entry if you miss this entry up here. So that's another example. I'll show you a few more. Right here, this is a little advanced. I'm not going to explain this, but basically this is a liquidity void. So on a footprint chart or in a 1 second, there is a giant gap here, which means no orders filled. What does that mean? Well, it means the price wants to rebalance there. So if there's no order fills, it's kind of like a gap on SPY. Everyone trading SPY, which by the way, I would recommend trading or watching ES instead of SPY, because ES has 24/7 data, so you can see real gaps. Everyone on SPY is like, oh, there's a gap fill play. There's no orders there. Well, it's kind of the same idea. On the 1 second chart, when we get this news, which the CPI news, there's no orders filled here. So if there's no orders filled there, well, that's where the market wants to go, because why would the market want to leave a price where no orders are filled? Because that means it's not balanced. You can see right here, boom, we get this tiny rejection to this fair value gap. Beginning of this fair value gap, we get about a 15-point rejection. But why do we not hit right here from this? Well, you can see that this news, we took out liquidity on this news, and then it set up this pointy low, which we took out liquidity, and you kind of want to wait for the reaction, but you can see as soon as you took out liquidity right here, we go up, and then here's your energetic displacement up. So we get a higher low, and then we get a lower high right here. So we get a lower high right here, lower high right here, and then boom. As soon as we rocket over the swing high, you're not entering calls yet. You're waiting for the fair value gap retracement. You can see that, yes, there's a fair value gap right here, but you wouldn't short this because we took out liquidity here. Once you take out some liquidity, you look for a reversal to go up again. And there's much more to this. Like this, I'm trying to explain this as simply as I can. This is what you call a buy model, which means that the target would be up here. And it's kind of got this certain curve to it. So this is kind of smart money reversal. This is distribution. This is redistribution, and then final distribution up here. This is kind of accumulation for shorts. You can see we have a giant fair value gap here. And again, this is more of a void. I think the void did not end right here, but we rejected just before. This is more a void, but it is still technically a fair value gap. So we get up to this void, we reject right here, we reject a breaker block, which is a lesson for another day. But see this red candle before this move? Well, once we break through that, it becomes a breaker block. So we reject this red candle right here, and then here's what's important to note. We hit this low. This is liquidity. This is when you look for market structure shift up, because we already hit liquidity right there. And then when you get this move up, see how energetic this is? This clearly shows a ton of buyers just made this go over the swing low. And what else do you see? You see fair value gap, okay? We wick into this fair value gap, boom, we bounce. And then you see another one right here. We do reject this one for a counter scalp. You can kind of see, like, we wick into this fair value gap, and then boom, our target's up here, and then we hit up here, okay? And if, let's say we got down here, well, I guarantee you we probably would have bounced if we got it down here, but we didn't. And sometimes that's going to happen. Sometimes you're not going to get your entries. But look what happens. Where do we bounce? Boom, this fair value gap right here, okay? And without even seeing this, okay? I didn't even see this. I was zoomed in over here. Why did I not draw the fair value gap here? Why did I not draw the fair value gap here? I could have easily been like, oh, I'm drawing the fair value gap here. Scrolled over, and then changed it to this one. Well, the reason why I didn't care about these is because, first of all, this one's the last fair value gap before this consolidation. So if we were to get down to it, I know it would be a good entry. And it's kind of that premium concept. So if we draw the fib from this low to this higher here, you can kind of see that only this fair value gap and this fair value gap is in discount. So these are the ones you would want to buy, but this one's also the 0.705, okay? So this would be obviously a more important fair value gap right there. So that's something definitely to take into account. And if this really hasn't opened up your eyes to how significant these fair value gaps are, I don't know what to tell you. I mean, it's fine using EMAs and stuff. I used to use all that stuff, but once I switch to this, I really can't unsee fair value gaps now and how the market actually moves. You can even see like fair value gap right here, boom, or we reject right here. And yeah, we have a fair value gap right here. I guarantee you, if we got up to this fair value gap, we would have rejected it, but unfortunately, we wicked just under it, this would have been a great entry off for FOMC, but we never hit it. So that's kind of an example. By the way, this was December 22nd, okay? This was CPI, I think. Oh no, this was CPI. This was PPI. Where did we reject the PPI wick? And how do people play news events? Well, I know people who play news events, and I know people who top tick news events. Well, look over. Fair value gap right here. Boom, PPI wicked right into here, and then down. And I did predict this on my Twitter. I did predict this in my Discord. A lot of times when they leave these fair value gaps up here, it's before news events. It makes for a good wick up and then down. That's usually what happens in news events. We go the opposite way, we wick. But you can see how precise this is. We just wick up to do it, and then boom, we hit sell side down here. The final target would have been this low right here, but we never hit it. We ended up hitting it later. So you can see we hit it later, which I expected. Here's another good example of a fair value gap. You can see like this one, if we draw the premium discount from this high to this low, this never hit premium, okay? So this one would I would not enter. I would enter it up here if we got the entry, but we didn't get the entry. So sometimes that's gonna happen, and yes, it sucks, but you're gonna have to deal with it. Like you can see, even right here, even when I was bearish, I will not. Like, I'll take profits of these fair value gaps sometimes if it's on the opposite side, just in case we bounce off them. And even though I am bearish in this moment, I was bearish to this kind of daily order block down here. you really have to pay attention. If you have a bullish bias, but you see a ton of bearish fair value gaps above, well, that's going to tell you you're probably going to get wrecked, okay? So I think having no bias is more important in this market than being like, oh, I'm going to swing calls. I think swinging is really dumb in options. I think playing futures is smarter because you can get in and out in a position overnight, because if you're swinging calls overnight, you don't know where price is going to open. Yes, we may pump overnight, but by the time we pump overnight, the price cycle might already change to a dump before open. So I think futures is a little smarter, especially if you think price is going to go up. But yeah, that's all I kind of got for now. You can see right now we are in a fair value gap, but I would not be shorting here. You can kind of see we're reacting to it. And yes, we could go down and hit this one, but the reason why I would not be shorting here is because on the daily, if you look at the daily, we are at an order block. So remember how I talked about this red candle before this up move is a bullish order block, and then we got a bearish order block, which would be this like green candle before this down move. For you, some of you guys obviously know that supply zones and demand zones, but it's really an order block. I would not be shorting down here in this order block. Yes, I can see price going to these equal lows, but again, the short entry was up here. I showed you guys that. So if you're gonna chase down here, you should probably wait for a whole new solid setup rather than shorting the 50th bearish fair value gap that we've had down here. You know, so again for tomorrow, I really have no bias right now. I am watching, like you can see, this is an order block, which this obviously honestly looks like a really good spot to reject just looking at it. But it's really risky to short because the short entry is way up here, and like in this fair value gap, or like I'm telling you, this fair value gap would have been a great entry. Like I would draw this on your chart. If we ever get back up to this, you can probably take this for a counter trend scalp. Same with this one. Like I can almost guarantee you're gonna make money off these for counter trend scalps if we get back up here. But again, you have to watch for the reactions. Sometimes, like what you can do is, if you get in here, you don't want to slap short right away. This is the 1 hour, so if we get in here, we'll go to the 3 minute and look for like a structure break in the 3 minute with a fair value gap. If we get that structure break on the 3 minute with a fair value gap, that's when you'd short instead of just slapping short in here. So I think that's a little smarter way to approach this. But honestly, this looks like a good rejection spot right here. For you guys to use support and resistance, which basically is fake. I guess you could say, oh, it's a old support line, which I hate support and resistance. It's not real. It's all liquidity. The market's all about liquidity. But you can see like this would be a great rejection spot to go down off this order block right here. For you guys in here, I'll update what happens in the morning. I'm fully expecting to be wrong. But here's what I'll say. I'm not just going to slap short off this. I'll look for another short setup if we get it. So what does that mean? Well, if we break this low right here with energetic displacement down, and then we get a fair value gap up here, I'll short that fair value gap. But until we get that, I won't short. So again, I have a really high win rate just waiting for that, because a lot of times it won't fail me. You'll have a lower win rate if you just slap them, like just slap randomly. There's also a fair value gap up here, which is important to note. This is in the 3 minute. And you'll find fair value gaps on every time frame. So you really want them to match up. But yeah, that's about all I got for now. Again, I would really recommend learning from the source, ICT, which is on YouTube for free. Just type in ICT Mentorship 2020. Does anyone have any questions? Just let me know in free chat, I guess. I'm reading free chat, and Golden View said taking a loss is a key part of success. Yes, taking a loss is so important, and I hate taking losses. But if your win rate is 66, or let's say your win rate is 80%, and you've won 8 trades in a row, well, if your 9th trade's a loss, well, that's really good, because there's a high chance if your 9th trade's a loss, well, your next trade is going to be a win based off your strategy. And I used to never think that way, which I think if you start thinking that way, you'll definitely be a better trader. Yeah, Greemkin, I can show you what an order block is, or a fair value gap. So a fair value gap is basically, you can see that, see this wick, and see this wick and this wick. See how they don't overlap? So the low of this candle does not overlap the high of this candle. It creates this gap in between. So you draw the fair value gap from here to here. And you can see in this candle, see how this wick does go over the low of this wick. So this high of the candle overlaps the low of this candle. So there's no gap in this. The only other one I see is like right here to this wick is a fair value gap. Another good one would be like right here. And obviously, if you guys just watch what I taught you, you know why this doesn't work. The gap is kind of like a rebalancing area for algos. So when we get this gap, it just means there's a ton of buying orders sitting in here, or buy orders sitting here. And again, there's certain fair value gaps you have to take. I know people who started learning ICT and they gave up on it because they tried slapping every fair value gap, but that's not how the strategy works at all. And I hate people who say that. But it basically means like there's going to be a ton of leftover orders in here. And this is where the algorithms like price to rebalance to get back into orders. So you can kind of see I drew it from this wick to this wick. This would be another fair value gap. This wick to this wick. I'm sure this was one on the 5-minute. This would be another fair value gap. This wick to this wick. And you can see, like, why wasn't this fair value gap respected? Well, we're bouncing off of fair value gap on this time frame, which is much more significant. So we're gonna blow by this one to hit liquidity right here. And yes, this is very, very complicated. You're not gonna understand this. I know you won't understand this because I didn't understand this when I started learning. You really have to watch ICT's videos. But you can see it creates this gap from here to here. And a lot of people are like, oh, it's just supply and demand. This is not supply and demand. This does look like a demand zone, but it's not because this is in the middle of the trend. Like a demand zone would be something like this. Price just rejects off this a bunch of times. But the reason why supply and demand is so bad is because look, you want to hit liquidity. Market hunts liquidity, so market's going to be hunting this low. It doesn't care about if this is the demand zone or not. Like, obviously, we get a huge reaction here off this, but next time we come down here, we don't really do shit when we get down here because it wants this low. Like, this is a fair value gap, as you can see. This is a wick. This is kind of a smaller one. Yes, there are indicators. This is a good indicator. This is not a fair value gap. I'm not sure why it has that. Maybe this is not. I don't really. I just see these so much now. I don't really have to. You could try this indicator. This is the first one that pops up. Yeah, Greemkin, you should definitely watch ICT's videos. Just type in ICT mentorship on, or you could just type in like how to use fair value gaps. T-Trades on YouTube is another really good source. It's gonna take you a while though. It took me so long. Like this used to be so complicated to me. Hunt small order blocks and join the winning side of trends. Not really, Greemkin. This is way different than, like, you're not really following the trend here. It's more of a reversal strategy. You're like top ticking reversals. But yes and no about trends, because sometimes like you can see we get a break of structure here, So automatically in your head, you should think, oh, we got a break of structure here, so now the market structure shift is bullish. We retraced up here, there's no fair value gap, and then boom. This isn't a market structure shift because we already shifted market structure shift right here. So this would be just a normal break in structure. So if we entered right here, this would just be following the trend, but just entering in a retracement. But ideally, the market structure shift retracement is a little better to take. Yes, I'll show you how I confirm. So if we're in the 1 hour, or if we're in the daily, and I see we're at, let's say, you probably have this on your chart. Well, you're going to say this is a demand zone. Well, how do you know where to enter in the demand zone? This is a 50-point zone, right? Like, you're not going to know where to enter. Also, by the way, while we're at it, if we get something, if we get up to this fair value gap, we will 100% reject this. I'm not sure how far we'll go, but I'm telling you, we will reject this zone. And this is not a supply zone. This is just a random zone in the middle of the price. So people who are like, oh, it's just supply and demand. Well, it's not. This would be more of a supply zone up here, but we probably wouldn't get up here because we're gonna reject this. But like, let's say you think we're gonna hit this high, okay? And you think we're gonna hit this high. You think we're gonna bounce off this demand zone, which is an order block. Well, you're not gonna enter calls here randomly because that's just really stupid. This is like a 100-point zone, so you can enter up here and then you could be 50 points in drawdown and you could lose your house, for all I know. Well, then that's when you want to go in like the 1 hour, maybe look for a 1 hour setup. But even then, like a 1 hour time frame might still be too big. So let's say you get a setup on the 1 hour, it's a 50-point zone. Well, that's still too big. So now what you want to do is like maybe go to the 5 or 3 minute. I think the 5 minute is better, because I think the 5 minutes is more safer for confirmation. And then that's when you look for kind of a trend up. So you can see we get a lower high. So we get a lower high. We get a lower high. Boom. Here's your higher high. Here's your higher low. You enter in the retracement. And when you enter in the retracement, your stop loss is below this. So this is going to be like a 10, 5, sometimes a 3-point stop versus, oh, if you enter just randomly in a 1 hour time frame, your stop loss would be like 100 points. Even the daily, like your stop loss would be your stop loss would be under this lower here. That's way too much. So that's when you want to go in the 3 minute, as I said. I also use the 1 minute wait a lot. I love the 1 minute. And this would be your stop loss. So this would be your stop loss instead of way down here, if you kind of get what I mean. But yeah, I would definitely recommend trying this indicator. I'm not really sure if it's good or not. This is interesting. So you can see we have a fair value gap here. All the wicks go way up through it, but we never close over the fair value gap. And this is just algorithms. This is all algos. If we broke this high, we probably would have gone up to this fair value gap and rejected, but algos won't let it. I'm not really sure why like it doesn't have this fair value gap in this So maybe this is not a great indicator, but you can clearly see this is a fair value gap. And it doesn't have any over here. Maybe I'm not sure why. Again, if you guys have a profitable strategy, I don't worry about this, but if I think this really, really will change your view in the market, especially after watching all ICT's videos. Okay, yeah, you could try that. Smart money concepts looks. Okay, so he says to try this one. Okay, so immediately, yes, this is very good. Why is this good? Well, it labels equal highs and equal lows. Labels change of character. Change of character is just a market structure shift. So as I just told you guys, we get a lower high, lower high. Why is this a change of character? Well, we break trend, okay? So we break trend and go up. So here's your change of character. So this is going to look for a retracement down here, and then you'd enter long down here. But again, this indicator is not going to know where liquidity is. That's going to take screen time. It has equal highs up here. This is a very interesting indicator. Has strong high, so it knows this is a change of character. It doesn't have any fair value gaps labeled over here. Maybe just because it doesn't allow it. I'm not sure why. And these zones are, I'm not hating on this indicator, but this is a very dumb zone. This is also a very dumb zone. This is also a very dumb zone. This is just a nothing zone. This is just like a fake supply. I don't even know what to call it, because if we were in the buy model, well, we'd have to hit this high. We're going to just randomly reject this zone. So I'm not sure what the zone is supposed to be. Maybe it just labels the swing highs and swing lows. Like, I'm not really sure what, because again, this zone isn't going to matter. We're going to break this zone. If we're looking to short, this zone is going to be broken automatically. So I'm not really sure what this is supposed to show. Yeah, chart time is the most important, because chart time is going to make you see things that you're only going to want to see and learn. And yeah, there's probably settings to make this a little better. I would have to mess around with it. Internal structure. So yeah, it seems like there's a bunch of settings with this, but again, if you watch ICTC's 2022 mentorship, all 40 episodes, and then you backtest in a trading view, you're gonna be a change trader. That's all I'm gonna say. But again, don't change your strategy. If you're profitable using EMAs or whatever that you use, don't change it if you're profitable. If you're not, if you're really trying to look for something to change your trading game, this would definitely be it. But I'm sure you guys join classes in here all the time, and someone talks about, oh, well, don't sell if we're on this EMA, blah, blah, blah. Well, you're probably hearing 50 different strategies, and if you're not profitable, well, that's your first problem. I see 2 people typing. Yes, the channel on YouTube is literally called Inner Circle Trader, and if you type in ICT 2022 mentorship, FVGs. Oh, I see it. Oh, it has IDR too. Oh, wait. Oh, never mind. Okay, IDR is another very, very good thing you should start learning. You can see we rejected the IDR low today. I'm not going to go over this now, but this is kind of something new that's come out, and I use it in combination with ICT. But if you guys are interested, just type in how to use IDR and on YouTube, and it's I think the thumbnail is like 88% probability. Let me check this out real quick. Yes, okay, I see that. Okay. Yep, so it looks like you can turn on fair value gaps and stuff. Again, I don't really like indicators. You'll know which fair value gaps to take and which not to take after you watch the ICT videos, but it's gonna take a lot of time. It's definitely something. It's not worth it if you're busy working or you're just lazy. You're not gonna understand it, and that's your fault. I can't really explain it other than that. If these indicators are available along. Okay, if these indicators are available, I don't really get what you're trying to say. These videos on YouTube, ICT does not teach with indicators. He mentions he has used 2 indicators in the past, which is like a Williams something percent indicator, which is totally irrelevant to what I'm showing you guys, and this other weird indicator, but he doesn't really use them. He just kind of sees them. And what gives you the edge with a strategy to execute and stay profitable when others are losing? Honestly, it's just a strategy. Honestly, it's just like the ICT concepts itself. It teaches you to short when people go long. Like it teaches you when people are gonna get stopped out. Like you're gonna know. Like if you guys know like Coach Dibka from Kane Capital, I've been texting him recently, and he's been starting to learn this. And he texted me one day, and he's like, "Dude, two people in Kane Capital, I'm not sure who it was, just alerted SPY puts, and I knew they were gonna get stopped out." And that was after he started learning ICT, and I'm like, "Yeah, I told you, dude." And he's like, "Yeah, dude, I'm not telling them they're gonna get stopped out because it's their strategy, but like it kind of teaches you like when people are gonna get stopped out." And I had 25 wins and 2 losses last month in my Discord. Like I run another Discord myself, and then I do this one. But like, yes, I need to take losses. Sometimes I won't alert things because I'm scared of taking losses, but I think losses is important. But I hate learning losses in like Discords, because then people are like, "Oh, you alerted a loss." But again, that's all up to that's not gonna keep you profitable. Like if I alert a loss and 3 wins and you're not profitable, well, that's on your risk reward. Does anyone have any other questions before I go? Yes, he teaches about the premium discount fib. I think that's in one of the first 5 videos. Knowing the premium and discount with any strategy is very important because it will tell you when not to enter. All right, well, I'm gonna end it here. Again, this is a lot more people in class than I usually have, and usually the people who do join my class, they already know what ICT is, and I'm sure, like I know Mitch in here, he's watched all the ICT videos. I know like what's the trend. He's from my Discord. He's watched the videos. But I would definitely recommend watching them if you haven't. Usually what I do is I don't really teach ICT in this because that's for ICT's job. What I usually do in my Sunday night classes, I kind of review my plays over the week, and I'll review plays where I get stopped out. I'll review my wins, and I'll kind of share what I was going through my mind at the time and why they worked and why some didn't work, etc. So that's what I usually do. But yeah, to see Mitch is typing, this is probably gonna be the last thing. Yes, as Mitch said, it ups your game if you put the time in. I know I used to be a horrible trader. Like I used to be in a group chat, and I would be like, "Oh, SPY calls look good here." And everyone would be like, "Oh, buy puts, buy puts." And some people are great fading indicators. Like I know someone who I can fade all the time in bank. And I used to be like that a lot. But since learning ICT, like no one ever like I'm in the same group chat. A lot of people tail my plays now. And some days I don't see anything I like, and that's okay. And I know some people are like, "Oh, well, if I'm paying for you to alert, well, I should get alerts." Well, I think one of the most important lessons I learned from ICT is when not to trade. I think that saved me a lot of losses. So definitely ups your time if you put the game in, or if you put the time in. But yeah, other than that, I'm gonna wrap it up here. Again, if you want to DM me questions, let me know if you think of something after end. But other than that, hope you guys learned something, and peace.